On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope everyone's well. It's that time again, so let's take a look back at last week, then let's turn our attention to the week ahead. And this will be the last episode of this type this year. I do have some other ones scheduled for over the break, but this will be the last week ahead episode until the second half of January when I come back from leave. Right, last week it was a mixed bag for global share markets. In the US, the S&P 500 slipped 0.6%, Europe was down 0.9%, the UK was marginally lower, the Aussie market down 1.5%. So some falls for most of those big international markets. However, the Japanese market did rise, it was up 0.7%, and emerging market equities were also slightly higher. Here in New Zealand, the local NZX 50 declined 0.4%, still up 8.4% this calendar year, on track for its best year in 4. It's still well behind many of those other markets around the world that are up 10, 20% or even more, but we are on track for our best year in 4, so it hasn't been too bad. Interest rates in the US, we saw rises in interest rates. The 10-year Treasury yield finished the week up 25 basis points, finished at 4.4%. That's the highest in 3 or 4 weeks. Here in New Zealand, little change really. The 5-year swap rate fell marginally to 3.67%, so not a lot of change here. The NZX Corporate Bond Index is actually up 6.3% in 2024, which is pretty good from fixed income. That comes on the back of a 7.5% gain in 2023. So the last time that we saw back-to-back gains of more than 6% was way back in 2011 and 2012. So it hasn't been too bad at all from fixed income these last 2 years. Right, key events from last week. We did have some inflation figures out of the US. The Consumer Price Index for November was out. It was in line with market forecasts, and that should clear the path for another rate cut from the Federal Reserve. That's coming up this week. The headline and the core CPI both rose 0.3% for the month. That took the annual increases to a 4-month high of 2.7% for the headline and 3.3% for the core measure, and that's the same as the previous 2 months. So you have seen inflation just creep higher these last 3 or 4 months. That's the bad news, but I suppose the good news is that this was no worse or no higher than people were expecting. We also had a couple of big central bank meetings last week. We had the European Central Bank making a decision and the Reserve Bank of Australia making a decision. We got one cut and we got one hold. The cut came from the ECB. It reduced its policy rate by another 0.25%. That takes it from 3.25% to 3%. That was the 4th cut of this cycle. Interest rates in Europe peaked at a euro era high of 4%, the highest since the euro currency has been around, and that came into being in the late 1990s. So interest rates peaked at 4, now they're down at 3. We've seen quite good progress on inflation in Europe. We've got headline inflation there sitting at 2.3%, core inflation also in the 2s at 2.7%. So the next meeting is in late January. That was the last one of the year for the ECB, and markets are expecting another cut in January, and they expect that ECB policy rate to fall under 2% by the middle of next year, which is interesting because no one's expecting the OCR here in New Zealand or the Fed funds rate in the US to fall below 2% anytime soon. So Europe is expected to cut rates more aggressively than other central banks. Across the Tasman, it was a hold that was expected, but a rate cut is edging closer. So cash rate over there, 4.35%. That's the highest since 2011. That's where it's been since late 2023. Remember, everyone else has been cutting, but the RBA hasn't. It's just stayed still. But that first cut is getting a little bit closer. While the RBA said that it didn't see inflation returning to the midpoint of its target until 2026, it did introduce a new phrase. And what it said was that it was gaining some confidence that inflationary pressures are declining. So that was quite key. That was quite important. They didn't say that at the last meeting. So markets now see that rate cut on the horizon. We might see a move in February, maybe it's 50-50, but I think we'll almost certainly see one by April if inflation keeps coming down. So some good news there for Australian borrowers, and that should be something that will be positive for the Australian market and economy as we head into 2025. Right, looking out to this week, and it is a super busy one actually. There's loads going on, both here in New Zealand and offshore. So this last full week of the year, last week of work for many of us, will have plenty of events to monitor across financial markets. Early in the week, we will get flash PMIs for December. PMI stands for Purchasing Managers Index, and these are essentially activity indicators. We'll get the Aussie one at 11 o'clock on Monday morning. Its Japanese counterpart will follow at 1:30 that day, and then you'll get the corresponding readings for the UK, Europe, and the US that evening, so Monday night and sort of into the early hours of Tuesday morning. Last month, the PMIs were mixed. The US economy looked very solid, but we saw some weakness emerging elsewhere. So you've still got that very strong US economy, but the picture definitely less encouraging elsewhere. Europe was quite soft. Japan, Australia, and the UK only just with their head above water in terms of being above that break-even level that separates expansion from contraction. So good pulse check for the global economy. We'll get that on Monday during the day and then into Monday night. There's 3 big central bank meetings coming up this week too, so they'll be very closely watched. And the biggest, the main event, will be the Federal Reserve. Its final meeting of this year, and the decision, the outcome, is due at 8 a.m. on Thursday here in New Zealand. So markets see a very high chance of another 0.25% rate cut. That would take the upper bound, because they do a range, the upper bound of the Fed funds rate to a 2-year low of 4.5%. The peak was 5.5%, just like it was here in New Zealand for the OCR, and this would bring it down to 4.5%. We've been going in 50 basis point increments. The Fed is only moving in 25 basis point increments. So we're at 4.25 even after this week's cut. Assuming we get one, they'll be a little bit higher than us still. So they're moving a little bit more slowly than us. We'll also get a fresh SEP at this meeting. That stands for Summary of Economic Projections. It's kind of the equivalent of our monetary policy statement. Gives you all those forecasts, helps you understand how the central bank is thinking about the economic landscape, inflation, and interest rates looking ahead to 2025. So this will be really interesting. I guess the other reason it will be interesting is the last time we heard from the Fed, it was just the day after the US election. So all of those questions that reporters hit Jerome Powell with about politics and Trump and all of that, he was able to bat those off and sort of say, well, look, it was only a day or two ago, so we don't really know yet. But he won't have that luxury this time. He'll get hit with all the same questions. Trump's policies, will they be inflationary, all of that sort of stuff. What does it mean for deficits? What does it mean for spending? What does it mean for prices? He'll have to answer those. So I think the press conference, which will be at 8:30 on Thursday morning, 30 minutes after the decision is out, that will be really, really interesting to watch. But it won't be the only central bank decision this week, because we also have one in the UK and one in Japan. So on Thursday, we'll hear from the Bank of Japan first. This will be highly anticipated. Officials are still pretty guarded on the timing of the next rate hike. They're hiking in Japan. Everyone else is cutting. We'll be here all day explaining why that is. I think I did record something on the Japanese situation not so long ago. Dig that out amongst the archives. But basically, the Bank of Japan had negative interest rates for 8 years, and we saw a rate hike earlier this year. Then we saw a follow-up rate hike. So there's still very, very low interest rates, but they're at least in positive territory. We'll get another increase at some point soon, but I don't think it'll be this week. You've got this backdrop of soft consumption. You've got uncertainty over potential policy changes in the US. So I think January or even March could be the more likely timing for the next move from the BOJ. We'll also get the Bank of England meeting on Thursday, so this will be Thursday evening. Markets don't expect any change there either. The policy rate sitting at 4.75%, and markets see the BOE pausing, with the next cut likely to come in February. So those are your 3 central bank meetings, all happening on Thursday. You might want to call it Super Thursday. I think you'll get a cut from the Fed. I think you'll get no change from the Japanese central bank and the UK central bank. More inflation figures due out of the US too. It won't be the CPI this week, it will be the Personal Consumption Expenditures Report, the PCE inflation report. This is actually the one that the Fed prefers, so it will be very closely watched. It always is. Comes out on Friday, so the Fed will have already made its decision, but still something that we watch as we're looking ahead to what they do next and into next year. PCE inflation is well off its highs, but like that regular CPI that we saw last week, PCE inflation has been a little bit stubborn lately, and we're expecting that to continue into November. The headline PCE is expected to rise at an annual pace of 2.5%. That would be up from 2.3 last month, and it would actually be the highest since July. The core PCE expected to rise for the month and at an annual rate of 2.8%. That'd be the same as a month ago. So very similar to what we saw from that CPI report last week. So that sort of rounds out that busy week of international and US releases, but here in New Zealand it will also be a very busy week. Early in the week we should get the last housing market update from the REINZ, the Real Estate Institute. I thought this might come out late last week, but it didn't, so I think it's due to come out on Monday or Tuesday, probably more likely Tuesday according to the calendar. Last month's figures did point to some signs of improvement across the housing market, although it's far from buoyant. So this will be interesting just to see if you're seeing any more action. How are things looking as we end the year and as we head into summer? Whether there's any evidence of those lower mortgage rates having any material effect on the housing market, on prices and activity. Probably Tuesday, that one, 9 a.m. The next day, Wednesday, we will get the last global dairy auction of the year. And the dairy sector's obviously been in good heart. Prices are up 22% in 2024, the highest in more than 2 years. Bit of currency weakness too, which has been helpful. And Fonterra has upgraded its milk price forecast, so they have a range of $9.50 to $10.50, midpoint of $10, which will be the highest of all time. The last record was 3 years ago, and that's when we saw a payout of $9.30. So $10, fantastic for the agricultural sector. The latest GDP figures are due here in New Zealand as well, and this will be a highlight of the local week. Even though it's a bit dated, it still gets a lot of attention. Gross domestic product for the September quarter, that's out at 10:45 a.m. on Thursday. Now, the economy's basically been in recession for the last 2 years. 7 of the last 8 quarters have shown a contraction on a per capita basis, on a per person, per household basis. While a recovery is on the horizon, it's not here just yet, and it certainly won't be evident in these figures, because remember, they cover July, August, September, and things were still pretty tough over that period. Maybe we'll see an improvement in the December quarter figures. That's the period that we're in right now, but we won't get those until early next year. So these are quite dated. They cover that July, August, September period, and I think we'll still be in recession, to be honest. The Reserve Bank has got us declining 0.2%. That's the same as we saw in the previous 3 months, and financial markets agree. Financial markets have also got us down 0.2%. So that'll be a highlight Thursday morning. Thursday afternoon, we'll get something forward-looking. Instead of a rearview mirror GDP report, we will get a fresh update on business sentiment with the ANZ Business Outlook for December. This has been much, much better lately. We've seen it recover to a 10-year high in terms of headline confidence, and the own activity measure has also been increasing. That's also at a 10-year high. We've seen inflation indicators easing. We've seen the net proportion of firms intending to raise their prices decline a little bit. So it all does look good for a more buoyant 2025. So I'm hopeful that that will be another piece of good news that we can look ahead to for the new year. Oh, almost forgot. We've also got the HYEFU. That's always exciting. The half-year economic and fiscal update, essentially the government opening the books and telling us how things are looking, and you get to see the Treasury forecast for borrowing and debt and so forth. This is out on Tuesday. I think it'll still look pretty challenging, to be honest, because the economy has been in a tough spot, so the tax take will be down, lots of spending needs in terms of infrastructure and so forth. So I expect it to look difficult, and I expect it to point to a further increase in what we need to borrow as a nation. So the government's borrowing program will probably be pushed up a little bit. On the corporate front, a few things to watch, a couple of international highlights. We've got FedEx, we've got Nike, both of those stocks reporting on Thursday. Darden Restaurants as well, also on Thursday. Here in New Zealand, it's a little bit quiet. We've got a Sanford AGM, we've got a Napier Port AGM. Sometimes you get a bit of a trading statement there. Across the Tasman, a couple of the banks holding annual meetings. NAB, that's the owner of BNZ, National Australia Bank, and ANZ, which is obviously our biggest bank here in New Zealand. It's holding its AGM on Thursday, so maybe you get a commentary about how things are looking across their businesses in all regions, including here. Right, that's us. Thank you for listening all year. This is episode number 230 odd, which is amazing. Still a couple to go this year, but they won't be week ahead ones. These will restart in the second half of January, same time, same place. So please do stay in touch over the break. I do have a few things to share with you, and if something happens and I'm really motivated to tell you all about it or give you my thoughts, I will jump online and record something, but we won't have these official week ahead sessions until early next year. All right, thanks team, talk again soon.
For more insights, visit craigsip.com.